How bank statements can secure your business loan. When businesses request loans, lenders need a way to ensure their financial stability before they grant the funds. Checking the company's bank statements is one way to do so. Loans that require such checks are called bank statement business loans. What is a bank statement loan? A bank statement loan relies on the borrower's bank statement to assess their financial health. Traditionally, loans rely on tax returns, W-2s, or pay stubs. This approach is helpful for freelancers, business owners, or the self-employed with high incomes. While their credit score may be great, they may not meet the requirements of traditional loans. This type of loan usually has higher interest rates and down payments. That's because lenders consider them riskier than most loans. How do bank statement loans work? In a bank statement business loan, businesses can use their bank statements to showcase their income. What are the 4 types of business loans? Term loans. These loans are funded as a lump sum and can be repaid over a specific period with fixed or variable interest rates. Lines of credit. Businesses can receive this loan as a line of credit and repay it as needed. SBA loans. Small Business Administration. SBA loans are backed by the government and offered by banks. They have good terms and lower down payments. Business credit cards. These cards offer revolving credit lines for business expenses. They're pretty flexible but may have higher interest rates. Benefits of a bank statement loan. Faster application process. Since these loans only need your bank statements for verification, the application and approval are pretty quick. Flexible eligibility requirements. Bank statement loans are good for businesses with incomes that are trickier to document through traditional methods. Higher approval rates. Bank statement loans can be provided to businesses with all kinds of income sources and financial health. Types of businesses that need bank statement business loans. Small businesses. Small businesses in their early stages don't have the right financial documentation or history to qualify for a traditional loan. With a bank statement business loan, you get a viable financing option based on your cash flow. Seasonal businesses. Businesses with seasonal fluctuations in revenue find it hard to showcase a consistent cash flow to traditional lenders. They can use bank statement loans to leverage their cash flow in peak seasons to get more funds. Startups. Startups don't have the financial history or collateral required for traditional loans. With a bank statement loan, startups can get their hands on financing with the help of their cash flow instead of historical data. Businesses with poor credit. Companies with less than perfect credit histories may struggle to qualify for traditional loans. Bank statement loans focus more on cash flow and less on credit scores, so they're perfect for businesses with lower credit scores. Applying for a bank statement business loan. First, you have to gather certain documentation for your bank statement business loan. That includes identification, business incorporation documents, profit and loss statements, and business tax returns. The lender will review at least 3 to 6 months' worth of your financial documentation. You'll also need to tell the lender about your business structure, industry, revenue, and purpose for the loan. Once you've given your loan application, the lender will assess your creditworthiness. If your request gets approved, the lender will give you a loan offer. Drawbacks of a bank statement business loan. Bank statement loans offer business owners a great deal of flexibility and accessibility, but they also have certain disadvantages. Higher interest rates. Shorter repayment terms. Bank statement loans may have shorter repayment terms, so you may have to pay more monthly. This may impact your cash flow, especially if you have an irregular income. Risk of default? For lenders, bank statement loans carry a higher risk of default. Businesses with unstable cash flow may not be able to meet their loan obligations, increasing the risk of default for both parties. Managing and repaying a bank statement business loan. Once you've acquired the right bank statement loan for your business, your top priority should be repaying it as soon as possible. Here are some tips for managing and repaying such a loan. First, create a repayment plan. It should outline how you'll repay the loan, how much you'll pay every time, how often you'll send the payments, etc. Repaying the loan should be the top priority in your company's budget. Allocate a specific amount every month to ensure repayments are made on time and in full every time. If possible, set up automatic loan payments to ensure each increment is made on time. This will help you avoid late fees and maintain a good credit score. Bank statement business loans are a smart way for companies to get funding by showing their financial statements. But before you invest in such a loan, you'll need a professional to decode the fine print. Contact us today to hire an expert financial advisor.